In this lesson, we're going to look at the bullish Kumo breakout. Personally, this is my favorite strategy, the Kumo breakout, because it happens quite frequently. And when the market reverses, this is one of the best trade setups to look at. But before we look at the Kumo breakout, it's important to look at for divergences in the market. And I think one of the best things about the Ichimoku Indicator system is that it's a standalone system. It has overbought, oversold levels, and you can see divergences. Now, this is an excellent example of a divergence. The Kumo was thick and then it became thin. Now, when the Kumo is thick, this is an excellent example where the market will face strong resistance. When the Kumo is thin, this is an excellent example where the market will break to the upside in this case. So, when we look before the price broke out of the Kumo, the first clue that gave us that the market could reverse is there was divergence between these two Kumos, thick and thin. Once we determine that, then price needs to break and close above the Kumo. In this example, price broke above the Kumo over here. That doesn't mean we take a trade. We have to look at all the other components, but this is a strong example of a bullish sentiment when that happens. Then we have to look at the relationship between the Tenkan and the Kijun-sen. Now, in a bullish Kumo breakout, the Tenkan must cross above the Kijun-sen either below or within the Kumo. In this example, which is the UK 100, the crossover happened below the Kumo. This is regarded as a weak signal, but I don't really take notice of this because the reason why sometimes you can have a weak signal, but the market still goes up so fast, so quick, so long, and it doesn't matter about whether the crossover is weak or is medium strong or is very strong. You have to look at all the components together to come to a conclusion. Once the crossover has happened, then we have to make sure what has the Tenkan and Kingston line doing? What are they doing? Are they pointing upwards or are they flat? If they're flat, that means the market is static. There's no volatility or there's no momentum, which means that we should avoid trading. But if the Tenkan is pointing upwards and the Kijun-sen is pointing upwards, this is a strong sign that the market is very bullish. If the width of these two lines are too far apart, then avoid trading. So you could have all your indicators telling you that the market is very bullish and you should enter a trade. But if the width of these two lines are too far apart, then you should avoid trading. Now, in this example, you might say, well, the width of these two lines were too far apart. Why would we enter the market over here? The main reason is because when this bullish candlestick happened, engulfing a candlestick, then the market moved up on this trade over here. The Kijun-sen was moving upwards. So this is a strong indication that we should enter the market at this level. Now that we looked at the relation between the Tenkan and the Kijun-sen and price breaking the Kumo, we have to look at the Chica span. The Chica span in a Kumo breakout, in a bullish Kumo breakout, needs to break above the Kumo in open space. So in this example, the Chica span broke above the Kumo. There's open space. But again, the reason why this wasn't successful was because price was too far away from the Kijun-sen. Therefore, even though it broke out of the Kumo and it was in open space, it went back to test the Kijun-sen. And as you notice, Chica span then hit this zone close to the Kumo and rebounded. In a bullish Kumo breakout, we should also look at that price is higher than 26 periods ago. Avoid taking a trade if the Chica span is still stuck in the Kumo because the trend is undecided. So in this example, we were to enter this trade on this candlestick, and if we were to take 26 periods backwards, of the Chica span, price would be over here. So that's an excellent example that the trend is bullish in nature, so we can take a trade. You should only consider taking a buy trade if the Kumo sentiment is either strong or medium. Now you remember in our previous lectures, you remember that the Kumo sentiment is very strong if the single span A and B are pointing upwards. It's medium in strength if the single span A is pointing upwards and the single span B is flat. So in this example, when we enter the trade over here, the single span A, which is this line, was pointing upwards, and the single span B was flat. So it's medium in strength. So now we have all the components of our trade setup telling us that this is a good buy signal. Now we need to place our stop loss. Now there's 4 examples where you can place your stop loss. You can place your stop loss on the flat Kijinsen, which is over here. You can place your stop loss on a single span A, which is over. You can do it over here. Do it right over here, or here, I'll say over here. Or you can do single span B, which is over here. Or you can do it on the breakout candlestick open price. So if you were to take a trade over here, you can do it. You can put your stop loss at the wick. That depends on your risk tolerance. Again, when you're looking at a trade, you should look at how many pips are you risking. In this example, personally, I would have personally put my stop loss on this candlestick, the wick, because the momentum is very strong. There are 5 different approaches to take profit for this strategy. The first place where you can take a profit are certain levels such as previous Kumos. The second example where you can take your profit is to wait for the current trend to be invalidated by a Tennyson-Kijisen cross occurring in the opposite direction of the trade. Now, in this example of the UK 100, there was no Kumo shadow, but the Tennyson cross below the Kijisen. That's a trend reversal. That's a bearish signal. So that's a perfect opportunity, this yellow circle, to get out of the trade. This is what I use most of the time. The third example where you can get out of the trade is there's divergence in the Kumo. As you can see, there wasn't divergence, but as you can, if you look below here, there was divergence here. Sometimes you get divergence, other times you don't. You just need to look out for them. And the fourth example where you can take profit is when the price breaches the Tennyson. Now, I don't usually use this all the time, but like I mentioned in the previous videos, but if we were to take this trade here, we could have got out over here because price breached the Tennyson, but the market was still bullish, as you can see. So this is, I don't really use this quite often. It depends on the news, and that's why I would be quite cautious in using this, but you can, depends on your risk tolerance. And finally, the fifth example which you can use to take profit is when price breaches the Kijinsen, which in this case happened when the Tennyson crossed below the Kijinsen over here. Well, that's the end of this lesson. Thank you very much for listening.